What happened? Why are you so sad?
I don't know what's going on. I invested thousands of dollars in the stock market. I did a lot of research and found companies with very good underlying financials, yet I keep losing more money.
I'm really sorry to hear that. My investments are working out just fine for me at the moment. What methods did you use for your research?
I looked at the current share prices of the companies that interested me. I assumed that the higher the share price, the higher the demand for a stock, so it must be a good investment if everyone is making it. I also compared PE ratios and invested in the stocks that had higher PEs. My reasoning was that a higher PE ratio shows that investors are willing to pay a higher share price today because of growth expectations in the future. And I really want to be a part of that growth.
I see. Sounds like you were better off attending this week's Professor Jia's class instead of doing your research. Let me teach you a lesson. The higher stock price doesn't mean that it's a good investment. Sometimes companies will artificially push up their stock price by repurchasing shares. On the other hand, certain companies have never done a stock split, so their share price is sky high.
So the stock price isn't a good indicator of a company's performance or attractiveness for investors? What about price-to-earnings ratio?
While your thinking isn't completely incorrect, and growth stocks can have abnormally high PEs, there is a negative side to the higher PE ratio. It can be misleading because it is either based on past data or projected future data, neither of which are reliable. It is also common for companies to manipulate accounting data. Finally, high PE suggests that the stock is overvalued.
So the PE method is also unreliable for stock valuation? Are there any better alternative methods that we can use?
There is no ideal method. For example, PE can be influenced by, among other things, demographic trends, impact from the business cycle, or inflation. To outweigh some of the disadvantages of the conventional PE approach, other measures were introduced. For example, the PE10 uses average earnings for the last 10 years, which is roughly the length of the business cycle. This way, it accounts for any swings in the economy that might occur. Another measure is the PEG approach, which takes into account the earnings growth rate.
Got it. Are there any other approaches to valuation, besides the PE?
Of course. There are many approaches, and the PE is just the most common comparative method. Analysts also make use of methods like price-to-book ratio, Gordon growth model, and the discounted cash flow model. You will know more about these valuation methods if you stop skipping classes. They might be very useful for your struggling portfolio.